Hi, I'm Peter and welcome to Module 4 of Making Money with Forex, brought to you by Raven Glen. And this module is entitled Moving Up a Gear, and we'll be looking at pending orders, swaps, multiple trades, trading volumes and gaps. So let's move straight in to pending orders. A pending order is a conditional order which will only be implemented if the condition involved is met, and the condition that we're talking about is the price rising to or falling to a specific preset level. Now, pending orders can be used for either buy or sell trades, and they both come in two types. So first of all, we have limit pending orders. These are used when we want to enter a new trade, but only after the price has moved in a direction that would make the trade entry point more advantageous. For example, you might want to put a buy trade on, but you only wanted to enter if the price falls by another 10 pips. And conversely, if you wanted to put a sell trade on, but only if the price rose by another set of pips. So basically a limit entry, it's an order placed to either buy below the current market price or sell above the current market price, and it saves you waiting and looking at your computer screen and waiting to do a manual entry. You can actually place that pending order and leave it to execute automatically by the system. Secondly, there are stop pending orders, and these are used when we believe that the market will continue in the same direction once it passes a predetermined level. So for instance, it may be that we're trading cable and we think that we want to place a sell trade if the cable price moves down from its current market level of 1.53050 down to 1.52950, as we then believe it's likely to continue to fall even further. So a stop entry order is an order which is placed to buy above the current market price or to sell below the current market price at a predetermined level. Pending orders also give us the opportunity to protect existing orders, which is also known as hedging. Effectively, these pending orders allow us to hedge against some or all of the increasing losses on an existing order which may be moving against us. This hedging can be accomplished with instant orders. They don't have to be pending orders, and it's a useful tool that we use at Raven Glen, and we'll talk more about it later. So we'll now look at some videos which will show us how to place a limit or a stop order, how to close them if you want to before they trigger, or indeed how to move the trigger level. Right, so let's have a look at placing an order here. Let's do a limit order. We'll do a buy limit, assuming that the price is going to come down to just below this Bollinger Band here. So if we actually click on our trading screen, right click at an area below the current price, you'll see that when we select our trading option, it gives us the opportunity, apart from placing a new order, to set a buy limit or a sell stop. So we'll select our buy limit. Again, just make sure you got the right currency pair and the right volume set in there. It's already filled in that it is a pending order and it's a buy limit, and it's set a price of 1.56863, because that's roughly where our cursor was when we right click to bring up our trading screen. But just let's make sure that that's the price that we want it to be. Well, we actually want it to be around about the 1.5688 price, so let's put that in. So we just amend that price and hit place. So our buy limit order is successful, and you can see here we have our buy limit in place here. There's also a sell limit on there which is from an earlier session. So we can see here now when we place a at market order, an immediate order, the orders are above this grey line which gives us our account balance. When we have a limit order, the limit orders before they're triggered are underneath this because they're pending, they haven't been actioned yet. If one of these orders are triggered, then they will move above and become a market actual order. Now you can see from our screen here that we've actually got two limit orders on. We've got a sell limit up here, which means that basically we're waiting to see if the price touches that level, we expect it to bounce back and to make some points on the sell trade. And conversely, we've got a buy limit order down here, just below the Bollinger Center point, and we're expecting if the price gets down to there, it will reverse and we will make some money on a buy trade. Now, we can also place our limit orders by right-clicking anywhere on the screen and selecting New Order, but instead of instant execution, we select a pending order, and when we look at the type, it gives us the opportunity to set a buy limit, sell limit, buy stop, or sell stop. So let's have a look at putting on a sell stop. Now in this case, stop orders, you're expecting the price direction to continue, so we will be looking at putting a sell stop on below where the market price is, but for it to continue in that direction afterwards. So let's have a look at where we might set this. So we might want to set our sell stop, for example, round about this level here, below the 1.56865 level, on the expectation that it may, once it gets down to there, it may continue all the way down to the bottom of the Bollinger. So let's put a sell stop level in of 1.5686. So simply do that by clicking on the arrow and adjusting the price. So 1.5686 as a sell stop. So let's place that, and there we see our sell stop order is placed at that particular point. So we've now got three pending orders on this particular screen. We've got our sell limit, which we hope would trigger as it reaches that point and reverses. We then take our profit off. Alternatively, if it goes the other way and hits our buy limit, that's because we're expecting it to bounce roughly around the center line in the Bollinger Band and move upwards, and we take some profit on the buy trade. Or alternatively, if it goes past the sell stop limit of the bottom order there, we would expect it perhaps to continue in a downward direction, and we would make some money on trading down towards the bottom level of the Bollinger Bands. Now you wouldn't necessarily have all of those three pending trades on at any one time. You may perhaps have two, maybe the upper sell limit and that buy limit, but it would be unlikely that you would have that buy limit and that sell stop in such close proximity to each other. But we'll talk more about entry and exit levels later on in the course. Now, if at any time we decide that we want to move the entry level of our particular pending trades, we can do so quite easily. Let's have a look at this one, for example, order 40401, our sell limit order. We simply double click on the order down below, and we will modify the order by changing the price. So let's move the price a little bit higher, to 5.6. In fact, let's move it above the 5.7 level. And we hit the modify button. We can see our sell limit has now moved up further away from the upper level of the Bollinger Band, and you can do those changes anytime before the trade becomes active. Now let's have a look at removing a pending order. Let's select this one, our buy limit order. We open it up, and to get rid of it, it's extremely easy. We simply press the highlighted delete button and we get confirmation, and our trade has now our pending trade has now disappeared. Now, multiple trades. It's very possible that you could have more than one trade open at any given time. There could be more than one buy trade, more than one sell trade, or indeed a combination of both buy and sell trades. And there are several different reasons why you may want to actually use multiple trades. It could be that you have a trade which is quite a long way from the current price and you want to continue trading while you wait for the price to move your existing trade into profit. Or it could be that an existing trade is going extremely well and you may wish that you'd actually placed a larger stake on it than you actually did. So placing an additional trade in the same direction might well reinforce that profit. Or maybe you want to protect yourself from further losses on an open trade by placing an opposite, either a buy or sell trade in place to counteract the effects of that, and we'll tell you more about that later on. But whatever the reason, on some trading platforms, the GKFX platform included, you can actually do this. If you do have multiple trades open, however, you do need to be very careful that you don't overtrade by having a total value of the trades open which is larger than the maximum of your 0.06% of your equity. We spoke about this in an earlier module. And managing open trades as well can be difficult if you have many of them, so you just need to be very careful that you're performing the actions on the trade that you think you are, and you need to keep an eye on them as they're nearing potentially entry and exit points or their take profit levels. So even though buy trades may cancel out exposure to sell trades and vice versa, it is very difficult that when you come close to the exit point of either and you do close them out, you could be very exposed, and we'll go into that in some more detail in a later module. We're now going to look at trading volumes. Now we have to be careful here because we've already come across the term volume before when we had our order placement screen open, because volume refers to the size of the bet that you're going to place. However, this time the term volume refers not to the bet size but to the total value of the trades going through the broker's system at any given time. And the volume in this context is important because the mass of the trades going through the system is a great driver of price changes. And what you will find is that generally the higher the volume of trades going through the system, the faster the rate of price change of the currency pair will be. Quite often when there is a large price change rapidly and there's no obvious explanation for it, such as some economic news, it's worthwhile checking out the volume, and you will quite often find that there is a large volume of trades going through that's driven that particular change. The volume is indicated at the bottom of our chart by a bar graph, and it's easy to turn it on and off, and we usually turn them off by default because sometimes they do get in the way of seeing the price action that interferes with some of the candlesticks. Well, let's have a look how to turn them on and off. So here we have a standard 1 hour chart, and if you want to display the volumes, we simply right click in the chart area, scroll down to volumes and left click, and you'll see the bar chart now appears at the bottom of the screen. And as I was saying, you'll quite often find that the larger the volumes indicated by the longer bars coincide with a larger price movement indicated by the longer candlesticks, and again here. Now, as I was saying, sometimes they interfere with the candlestick visibility, so by default we turn them off, and you do that by right clicking on the screen, clicking on volumes again, and you're back to your normal chart. Our next topic is gaps. Now, a gap is said to occur when the closing price of one candle doesn't line up with the opening price of the next candlestick. Now, this gapping can either be in an up or a downward phase and can occur in any time scale. Now, the reason for gaps occurring is occasionally down to a system's communication error, but it's usually news based. Either something very significant has happened in terms of a financial or economic news announcement, or the news event may have accumulated when the market's been closed, such as over the weekend, for example. And here we have a perfect example of a gap appearing. So you can see the closing of this candlestick doesn't match up with the opening of the following candlestick, as it does in all of the other candlesticks shown on this page. Now, what you will find is that there is quite often a retracement back towards the opening of the gap, and this does often give us the opportunity to trade that retracement and to take some profits. Sunday night gapping quite often occurs, as there may have been some news over the weekend, and the opening price at 10 PM UK time on a Sunday night is often some distance away from the closing price of Friday's trading. There is one point to note, however, that gaps can be very dangerous because they can sometimes cause pending orders to fail, or also not trigger stop losses or take profit orders, because the system doesn't actually see the market trading at that price. If that price is in the gap, it bypasses it, and sometimes it can lead to unpredictable circumstances which can lead to either losses or a severe impact on your trade. Let's take a moment now to check your understanding of some of the items we've covered in this module. Firstly, what are the 4 variants of a pending order that you can have? Secondly, when do swaps arise? And third, what will limit the number of open trades that you have on at any time? If you can answer those 3 questions, then you've certainly absorbed most of the content of this module.